In this video, we will talk about challenges in small business financing and funding options. Acquiring capital is crucial for launching new ventures, yet entrepreneurs consistently face fundraising challenges. Common missteps involve a lack of understanding of the distinct needs of lenders and investors. Lenders, primarily concerned with risk management and the business's capacity to repay credit, are indifferent to the business owner's vision for a great business. Securing credit as a small business can be highly challenging, requiring a solid financial plan for debt repayment and assets that can serve as collateral. Navigating the equity investor landscape is even more complex. Investors, with diverse objectives, need an exit strategy. Entrepreneurs often face obstacles in raising equity due to a misunderstanding of investor needs. Capital market fluctuations, economic conditions, and investor fortunes create a roller coaster effect on capital availability, intensifying the challenges in financing. Entrepreneurs in industries that are less glamorous or still emerging face challenges in obtaining external funding. They encounter hesitation from banks, a tendency for venture capitalists to prefer larger deals, cautious private investors, and limited feasibility for public stock offerings. This dynamic results in a credit crunch for entrepreneurs seeking moderate startup capital, especially those in the $100,000 to $3 million range. Meanwhile, the availability of credit for small businesses hinges on economic conditions, flowing more freely during economic growth and tightening during slowdowns. Small businesses bear the brunt of these shifts more than larger corporations. Additionally, the financial strength and operational history of a small business significantly influence its creditworthiness. Most banks prefer lending to small firms with at least 3 years of operational history and 2 years of profitability. Equity capital embodies the personal investment of the owner in a business and is often referred to as risk capital, as these investors bear the primary risk of losing their funds in the event of business failure. Equity investors have the entitlement to share in the company's earnings, if any, and typically wield influence in determining the company's future direction. However, the drawback is that entrepreneurs must relinquish some ownership in the business to external parties. On the other hand, debt capital constitutes the financing borrowed by entrepreneurs, requiring repayment with interest. Given the limited personal savings of many entrepreneurs to cover total startup costs, reliance on some form of debt capital is common. While lenders of capital outnumber investors, obtaining small business loans can be just as challenging, if not more so. Although borrowed capital allows entrepreneurs to retain full ownership, it appears as a liability on the balance sheet and must be repaid with interest in the future. Lenders, perceiving small businesses as higher risks, demand higher interest rates due to the risk-return trade-off. The greater the risk, the higher the return sought. The key benefit equity financing offers over debt financing is the fact that equity capital, unlike a loan, doesn't necessitate repayment. Angel investors, often affluent individuals and frequently entrepreneurs themselves, meet the criteria of accredited investors and choose to invest their personal funds in startup enterprises in exchange for equity stakes. Their engagement can take the form of a one-time injection of seed money or continuous financial backing to bring a product to market. Networking is essential for pinpointing potential angel investors in entrepreneurial ventures. A productive starting point involves seeking recommendations and introductions from friends and family. Given angels' preference for local investments, entrepreneurs are advised to focus their search in proximity. Angels exhibit an interest for businesses within their expertise, anticipating contributions not just in financial terms but also through their knowledge and energy. The guidance and network of contacts that angels provide can be as valuable as their financial contributions. The Internet, facilitated by platforms like Angel Capital Association and AngelList, has significantly broadened the avenues for entrepreneurs and angels to connect. Angel Forum distinguishes itself as a company facilitating connections between startups and investors, nurturing a community to support angel rounds. All investors affiliated with Angel Forum are seasoned professionals with substantial experience, ensuring entrepreneurs engage with knowledgeable angels. Going beyond investor-specific platforms, social media, particularly Twitter, has become a dynamic space for connecting startup founders with angel investors. The Angel Investment Network, a US-based platform, plays a crucial role in bringing startups and angel investors closer together. With access to a directory of 285,542 angel investors worldwide, it provides a valuable platform for connection. Commercial banks serve as the central hub in the financial market for small businesses, offering the largest array and quantity of loans to these enterprises. 71% of small companies with employees carry outstanding debt. Bankers exhibit a preference for extending loans to established businesses with proven track records, emphasizing scrutiny of a firm's operational history and financial reports to project its future standing. Stability in the company's sales and its capacity to generate sufficient cash flow for loan repayment are crucial considerations. Short-term loans, with a repayment period of less than 1 year, encompass various types, such as merchant cash advances, lines of credit, payday loans, online or installment loans, and invoice financing. These loans feature a quicker funding time, a shorter period for incurring interest, and are generally easier to obtain, although they typically provide smaller loan amounts. Intermediate-term loans, lasting 1 to 3 years, have fixed maturity dates and payment schedules, often repaid directly from the financed asset. Examples include peer-to-peer loans and business lines of credit. Long-term loans extend beyond 3 years in repayment duration. Traditional banks may offer these loans with favorable interest rates and extended terms compared to some other lenders. However, the application process can be lengthier, requiring more documentation and stricter requirements. Obtaining a long-term business loan involves determining the desired financing type and selecting an appropriate lender. The application entails submitting necessary business information, with eligibility criteria varying by lender. Upon approval, the lump sum amount is provided up front, allowing flexibility for business use. Repayment typically occurs through monthly payments, although daily or weekly structures may also be available.